Good afternoon, CQA board. We are from Wilkes University here at the Situ School of Business and Leadership. In this video, we'll be discussing our portfolio for the challenge, and we'll be covering our philosophy and model that we used, including our stock selection and how we use the model to pick those, our risk and return expectations for our portfolio, as well as most importantly, our performance over the last few months. We will then be discussing adjustments that we have made and will be making in the future to increase our portfolio. And then we'll finish it up with a conclusion. For introductions, this is our team, including Dr. Wong and Dr. Freer, who are both our faculty advisors, and Dave Burkett, who is our CQA advisor. I'm Aaron Sadowski. I'm a senior finance major here.
My name is Jorge Gonzalez. I'm a junior finance here.
My name is Kyle Gattuso. I'm a junior finance major.
My name is James Palace. I'm a senior finance major.
My name is Noah Durden. I'm a junior finance and accounting major.
Going over our investment philosophy, we had three major bets. One of those was medium to short-term momentum, and the other two were two major sector bets. The first of those was in the technology sector, and then next was in the retail sector. Our technology sector bet was predominantly on the long side, while our retail sector bet was predominantly on the short side. For our model that we created, we used three major factor groups. The first of those was price momentum. Next, we used historical growth, and last, earnings momentum. Taking a deeper look at the factor groups that we used to create our model, first off, we used price momentum. Within that group, we used 5 different factors. The first of those was 12-month active return with 1 month lag. Next, we used the put-call ratio. Next, after that, we used the 51-week volume price trend with 4-week lag. Followed by that, we used the 1-year price momentum indicator, and lastly, the 14-day relative strength index. For our next factor group of historical growth, we used 5 different factors. The first was 1-year change in price-adjusted trailing 12 months earnings per share. Next, 1-year change in price-adjusted trailing 12 months free cash flow. Following that, 1-year growth in trailing 12 months free cash flow. Following that, 1-year growth in trailing 12 months earnings per share. And lastly, 1-year change in sales. In our last factor group, earnings momentum, we used 5 different factors. The first was 1 quarter ahead earnings per share growth. Next, 1 year ahead earnings per share growth. Following that, risk-adjusted PEG ratio. After that, sales surprise, and lastly, real earnings surprise. All of the factors within the model were weighted equally, and the model was used as a basis for all of our investment decisions.
Our portfolio was constructed of 3 asset classes. They were short equities, long equities, and margin loans. 33.4% were in short equities, 36.9% were in long equities, and 29.6% were in margin loans. The majority of the companies we invested in were in the large cap universe, followed at 70.6%, followed by mid cap at 27.4%, and small cap at 2%. The 3 sectors that our portfolio really concentrated on were services, technology, and consumer goods. Services made up 46.3% of our portfolio, technology made up 19.5% of our portfolio, and consumer good made up 13.2% of our portfolio. Some other sectors that were involved in our portfolio were industrial goods, basic materials, and healthcare.
We took large sector exposure bets in technology and retail. As you can see in our active style exposure, we are heavily involved in short, medium term momentum and growth. As you can see in our active sector weight, we are heavily in information technology as long as consumer discretionary. With this being said, we expected a high return for our high risk portfolio, but resulted in a loss, but we have made adjustments in the turn of the new year that will be discussed at a later point. Overall, we expected our returns to follow the market. Unfortunately, retail jumped up a lot more than we had anticipated. With our new adjustments, we believe that we'll be able to cover our losses and even turn a profit in the future.
As you can see, this chart compares the return performance of our portfolio to the S&P 500. As you can see, the beginning of the competition hurt our portfolio. The biggest thing that hurt us in the beginning was the announcement of earnings for securities that we were shorting, such as Foot Locker, Dick's Sporting Goods, GameStop, and Gap. Those were our biggest losers, and they were each about 30% loss. The strong earnings from those companies brought us to our lowest point, which was a little over 11% total portfolio loss on the 4th of December. And that was also last place in the competition. Since then, we changed some things around in our portfolio that helped us grow a little more than 11% in the last 2 months, from when we were down 11%. Currently, we are ranked 30th in the competition on February 1st. We all agree that we should have had a stricter plan on what would happen if we were to take a loss, such as implementing a stop-loss plan. Instead, we just let our losses get even worse with the hopes of them coming back down. As you can see, most of our longs were gains. As a group, we don't want to change much with how our longs are, except for a few things. For the future of our competition, we would want to diversify our assets more, which would mean cashing out on our gains by selling half of our equity. Another thing we would want to do is try to find small name companies where we can benefit from their growth. On our short side, our shorts were the main reason for our early decline, and we are constantly looking at different ideas where we can change our shorts for the better. One of the factors that we wanted to change in our shorts was the diversity. We realized that we took heavier bets on shorts which showed in our performance that it was a bad idea. From our worst moment, we started to diversify our shorts more, cutting our losses on shorts, and as well as finding smaller companies that have bad financials. Another factor that we want to change about our shorts is that we want to short less riskier stocks so our performance from our longs can take us into the positive.
In conclusion, the team here at Wilkes University and the JS School of Business and Leadership want to thank everyone at the CQA board, in particular Dave Burkett and Sam Stovall, for all of their help in helping us put this competition together and help putting this video together and our portfolio. We are truly appreciative of everything that you guys have done for us, and we're very happy to be a part of the competition this year and hopefully many more years to come. Thank you very much.